Okay, you guys, we're now going to look at how to prepare an amortization schedule and make journal entries when bonds are issued at a premium. Now, we did the calculations to get the issue price on the Handout 4 video, and we went through these journal entries and prepared the amortization schedule when the bonds were issued at a discount in the last video. Here, of course, we're dealing with a premium. The issue price was $807,911, while the face value was only $750,000. So when the bonds are issued above face value, we have a premium. And we're going to use the effective interest method, just like we did on the discount video. There, this will mean that our cash paid for interest and our interest expense will be different each period. Here, since there was a premium, cash paid for interest will actually exceed interest expense recorded because that extra received up front ends up reducing future periods' interest expense. So we'll fill out the chart here first. This one's set up a little nicer. It's a little closer to the journal entries. Okay, so we'll say our original carrying amount is the issue price, $807,911. Again, that's from here, and we made the calculations a couple videos back. All right, so now our interest payment each time. Let's see. Okay, so to get the interest payment amount each period, we'll say the face amount or face value $750,000 times half the stated rate. The stated rate here was 12%, so half that would be 0.06 or 6%. So our interest payment that we'll make each every 6 months is going to be $45,000, and that's the same each time. I'll just fill that in. So the interest payment stays the same each period because it's half the stated rate times the face amount, and the stated rate and face amount don't change. Now the interest expense will be calculated as half the effective rate times the carrying value. So we've got a carrying value of $807,911 times half the effective rate. The effective rate was 10%, half of which, of course, is 5%. So our interest expense is $40,396, we'll say. All right, the difference in those two will be the amount of premium amortized this period, and that's going to be $4,604. Let's check that just to make sure. 45,000 minus 40,396. Yes, 4604 will be the amount of premium amortized. Now, when we amortize the discount, you guys, it was added back to the carrying value. Here, it'll be subtracted from the carrying value when we amortize a premium. I didn't mention this in the last video, but had we carried it out the entire way for all 10 interest payment periods, the carrying amount will always end up being equal to face amount. So that should make sense, right? As we amortize the premium, it decreases the carrying value down to the face amount. But as we amortize a discount, it increases the carrying value up to the face amount. Okay, so here we'll subtract the 4604 from 807,911. And we get, that's incorrect. Okay, so 807, we get the wrong answer. 807,911 minus 4604 $803,307. Okay. Now we just keep going. We'll take that amount times half the effective rate of 10%. Again, half that would be 5%. So our new interest expense number for June 30th, 2025 is $40,165. Okay, the amount of premium amortized will be the difference in the interest payment and interest expense, and that's going to be $4,835. Okay, and then that will be subtracted from the previous carrying value to get our new carrying value. So 803,307 minus 4835 gives us 798,472. All right, so that'll be our carrying value at the end of June 2025. Then to get the interest expense for December 31, 2025, we'll just multiply again by half the effective rate, or 5%. We get interest expense this time of $39,924. Okay, and then our amortization of the premium will be the difference in cash paid for interest and our interest expense. So 5,076, which will be deducted from the 798,472. We end up with a carrying amount here of $793,396. Which will multiply by 5%, half the effective or market rate. To get our interest expense here, 39,660. Let's go with 39,670. Okay, and our premium amortization of the premium will be the difference in interest expense and the payment. So 5,330, which we'll subtract from 793,396. And we end up with 788,066 as our carrying value at the end of June 2026. You guys, if we carried this all the way out again for 10 interest payment periods, the carrying value would end up at 750,000, equal to the face amount. Now let's go through these journal entries. When the bonds were issued here on 6/30/24, the issuing corporation would have debited cash for the amount received, the issue price. We credit premium on bonds payable. Let's come back to that amount though. We know we're going to credit bonds payable for the face amount, $750,000. We know we'll debit cash for the issue price. So to balance the entry, we need more credit, and that's going to be our premium, $57,911. So assets increased by $807,911, and liabilities increased by $750,000, but were decreased by the premium, increased also by the premium and the credit to bonds payable. So liabilities increased by $807,911, and that's cash coming in from a financing activity. All right, you guys, so again, we debit cash there for the issue price. We credit bonds payable, as always, for the face amount. And then we need more credit to balance the entry. We debit the premium on bonds payable, but probably the better way to look at that, when the cash received exceeds the face amount, we've got a premium, which goes on the books as a credit. When the opposite is true, when cash proceeds are less than the face amount, then we need more debit to balance the entry, and we'll call that, of course, a discount. Okay, our next interest payment date is 12/31/24. So here we will debit interest expense for $40,396. We're going to debit the premium for $46.04. It went on the books as a credit, would come off the books as a debit. And then we're going to credit cash for the amount of cash paid for interest, $45,000. Now in this case, interest expense increased expenses by $40,396, causing net income to decrease by $40,396. Which in turn would cause stockholders' equity through retained earnings to decrease by $40,396. And then assets decreased by $45,000. And when we amortize the premium, that's going to decrease our liability bonds payable by the amount of amortization of the premium. And then I apologize there for my dog. Someone just showed up on the porch knocking on the door, and my dogs went crazy. But I'm sure a lot of you can understand that. Anyway, I wouldn't want them to let a stranger go unnoticed. So we want to make our entry on 6/30/25. I'm trying to keep it where we can see both, but I'm not quite going to be able to. What's going to happen here? We're going to debit interest expense for $40,165. We're going to debit the premium for $48.35. And then we're going to credit cash for $45,000. That means our expenses, interest expense specifically, increased by $40,165, causing net income to decrease by $40,165. Of course, an interest payment is an operating activity. I don't know if I mentioned that here, but of course it is. We've talked about it many times. The decrease in net income would also cause a decrease in stockholders' equity. The credit to cash, of course, represents a $45,000 decrease in assets. And then the amortization of the premium causes our liability bonds payable to decrease. You guys, that's about everything you could run into, in the early years anyway, of a bond issue. And, mainly we would like for you guys to know that bonds are another financing source for corporations, especially large publicly traded corporations. And it's a form of debt rather than a form of equity. And that if the bonds are issued, if the stated rate of the bonds is greater than the market rate, well, we know then there'll be a premium. I think this can be helpful just to know that. And then if the stated rate of the bonds is less than the market rate, we know that the bonds will be issued at a discount. Thanks for going through these with us, and if I can help you, please be in touch.